Hey everyone, me Kevin here. Well, we've reached a deal on the debt ceiling, and now there are still some hurdles of things that could go wrong, but I wanted to break down the details of the latest things that are tentatively within this tentative deal and what it means for us. First of all, let's start with this. A course member asked me on Thursday if they should be buying shorts on this market. I said, the big risk you're running buying shorts going into this 3-day weekend is that you've got 3 days with no ability to close out your shorts, or a debt deal could get done. And it looks like that's what's happening. Now, no guarantees that the market's going to skyrocket on this. All it takes is Jay Powell or, someone from the Fed coming out and saying, you know what, we are going to raise rates again in June, which so far the market is actually pricing in that we are going to get another rate hike, even though Jerome Powell's basically committed to the idea of a pause. Although then there's this idea of maybe we pause in June and re-hike again in July, which is weird because that brings us back to the mid-70s, which led to the Paul Volcker era. Not what you want to hear. But forget the Fed for a moment. Let's think about the deals here, or the details of this deal. So basically, we had a 90-minute phone call between Biden and McCarthy, the two teams, to negotiate the final details of the framework that they had roughly agreed to earlier this week. Now, Janet Yellen this morning came out and gave a revised X date. That's the date where the Treasury Department expects to run out of money. At first, she gave a date of June 1st. However, this led a lot of Republicans to say, nah, that's a BS deadline. Most of the Wall Street expectations are June 8th through 9th. Which honestly, there's probably some buffer room she's giving because she, if we hit that date, wants to be able to have a few extra days just in case a deal is done. And you got to get the procedurals done, like the actual bill voted on, which we got to talk about that because there could be some things that come up and actually slow that process down too. The hardlining could still happen, so buckle up for that. But Janet Yellen this morning came out and announced that June 5th would be the day that the Treasury Department has about $130 billion of payments that need to be made, and that's going to be pretty tight. So maybe June 5th is actually the X date. Either way, here's the framework of roughly what was agreed to between McCarthy and Joe Biden. After Janet Yellen came out with this date, a lot of folks say that was sort of the leftover motivation Republicans needed to get over the edge, though realistically, I'm not sure how much of this date mattered, whether it was the 1st or the 5th. We just got to get it done. So what are the details roughly? Well, we'll get the full text of the bill supposedly tomorrow, though during the COVID days, we all remember, we would always hear, oh yeah, the bill's coming out tomorrow, and then it would be like tomorrow. It was always tomorrow. But anyway, the rough framework is agreeing to approximately a 2-year raise of fiscal spending at roughly the same levels where they are now, and anything that's been agreed to, in other words, any payments that have already been agreed to via bills will be approved, so we're good with that. It's not like we're renegotiating existing bills. However, there is some sort of cap on how much extra discretionary spending could be authorized by the government. We're going to spend roughly about the same amount in 2024 as we expect to spend in 2023. That's a win for Republicans, with about a 1% boost in spending from 2024 to 2025. That does get us through the presidential election cycle, which is exactly what Democrats and Republicans want. Nobody wants this sort of hard lining during a presidential election. That would be a disaster. So this is really seen as a win for partially both sides. Republicans will probably be able to say, hey, look, we're reducing spending, the New York Times says this at least, by about $650 billion over the next decade. The Wall Street Journal, which leans a little right, while the New York Times leans a little left, they say, it's unlikely to change really anything. And Politico is kind of like, we're basically keeping spending flattish. So really, it doesn't seem like there's some huge major cuts here, though Republicans are going to be able to cheer the fact that they limited that IRS spending from $80 billion down to $70 billion. Republicans originally wanted $20 billion off of IRS spending as opposed to new work requirements for those receiving some certain entitlement programs. And, I know sometimes that's an offensive phrase to say, but, food stamp access and SNAP program benefit access, which is the official name for the program. Anyway, that's probably the more appropriate way to describe it. You have to be so careful with what you say these days. Everybody's so sensitive. But anyway, you did get slightly increased work requirements here. So what you got is basically anybody currently under 49 who does not have children has the requirement to work. And basically what they did is they took that age and they moved it up to 54. So 54 and under will now be subject to work requirement rules. And as a give to Democrats, no new work requirements for Medicaid programs. Remember, CAID is for poor, CARE is for old. Okay, great. So again, Democrats are going to be able to cheer that they didn't get, that they were able to protect funding for the SNAP food programs. This includes the Temporary Assistance for Needy Families program as well. And Republicans are going to cheer the fact that they did get a clawback from the IRS funding. They also got a little bit of clawback of unspent COVID money and also got a little bit of an increase in these work requirements. Do keep in mind that the program will also expand access to veterans and homeless. Tentatively, some of these things are just being sort of leaked. So different agencies and different publications are reporting different things, mostly because the formal text of the bill and framework of the bill isn't out yet, but we'll get more details over the weekend, over the Memorial Day weekend here. So, Memorial Day weekend, wait a minute. Yeah. So the next thing that we need to know, well, hold on, what day is Memorial Day? Memorial Day 2023. Why is this? Oh, it is the 29th. Yeah, of course, that's the day off. See, all my employees get their day off on Monday. They know when these holidays are because it's the paid day off. That's okay. I think we've got too many paid days off, but we follow the, I do this on purpose. At our companies, everyone that I have, we follow the Office of Personnel Management days off, paid days off, and it's the government's days off. So in other words, there are a lot of them, and it's a good thing. I'm a big fan of that and people getting some R&R time. Work hard, play hard. I'm a big fan of that. We're actually out here in NorCal. Oh boy, I might make a video on San Francisco, but San Francisco is just a complete disaster. We had to leave San Francisco because Lauren didn't feel safe. It was that crazy, but we're looking at a little bit real estate, a little bit family. Looking at real estate, though, I really enjoy. So anyway, and more updates to come on House Hack. That'll be really fun. But I want to talk about some implications and what's next for this debt ceiling deal. Do keep in mind as well, we're dropping the AI lectures on June 1st, and then pricing will be going up for all of the courses across the board on building your wealth and making more money. Check those out, linked down below. So going forward, what's important to know is we still have some potential hurdles from hardliners coming. So this is where you could basically have some of the further left progressives or those on the further right basically come back and say, hey, you know what? We're going to try to use some procedural tricks to basically put leadership through some hoops and hurdles to force a delay of a vote on this bill. I think that's partially why more and more Republicans wanted to hear, hey, what's the actual X date, so we could play some procedural drama. The reason for this is really so those individuals can go back to their districts and say, hey, I tried every trick in the book and they still passed this. I didn't want them to authorize even a penny more of spend, so I tried to delay it. It didn't work. Well, no, it didn't work. Because once the moderate votes are in and this deal is struck, it's done. So I would say, from a practical point of view, even though the deal is not done and there's likely to still be clickbait drama about how a deal is not done yet, and yes, something could go wrong, I'd say, 99 out of 100 here, this deal is done. The debt ceiling is going to get raised over the next 2 weeks. It's going to take a lot of anxiety out of the market. Because this anxiety is going to get taken out of the market, and because the market is already pricing in a hike for June, there are not really that many negative catalysts left. Now, that's a problem for some people because, and I get it, I know what it's like, but there are some companies out there that fundamentally just are not good companies and their stocks are skyrocketing, and that's leading a lot of people to go, what is this? The bears should be winning. We should short these companies. I think this is probably a very dangerous time to short. That's not to say we're not going to have some kind of short-term, retracement on some of the Fibonacci levels that we've been hitting. But I think shorting now would be, quite frankly, dangerous and not a wise thing just because there are not a lot of new negative catalysts. Think about the negative catalysts that we've gone through in the last 18 months. Really think about this for a moment. The COVID reopening was supposed to be a big second wave of inflation. No, it didn't happen. The invasion of Ukraine happened within the last 18 months. Yeah, that was painful. That led to another wave of inflation, but we're through it now. Hitting peak inflation in Germany, while in America, but while I was reporting it while I was in Germany with the family last summer. I remember doing that video from the beach in Germany, live for CPI. But anyway, we were looking at this and like, oh my gosh, peak inflation, this is terrible. We're past that now. Yet now the argument is, but maybe there's sticky inflation. Okay, really, that's all you got? The Fed has played the opportunistic disinflation game before. AI is going to lead to a big boost in productivity spending from businesses. Business fixed investment will probably go up thanks to AI. Consumer spending is still rising. People are still spending like crazy. We're still expecting record travel spend this summer. All of that, yes, is inflationary. Will it lead to another oil price surge? Unlikely, because the Chinese spending boom just hasn't been fantastic. If anything, China's been a little bit of an anchor to not only commodities actually staying low. Look at iron and copper charts. Sorry, commodities, Steve. And also, quite frankly, oil. So even though you could see more spend in America and Europe, you're seeing less in China, is anchoring, especially industrial spend in China, is anchoring some of your inflationary expectations for oil. So really, this is a dangerous market to short. I think it's a dangerous market to be under allocated on, because this market, as much as people will look at this market and go, oh, it's just a bubble, you could be at inning 1 of an AI bubble, and you could say it's a bubble for the next 8 innings. And yeah, maybe eventually it's going to burst. And you know what? I'll tell you today, mark this. Somebody mark this on the calendar and remind me in 8 years or whatever. But I believe there will be an AI bubble burst at some point. The companies that will burst in it, though, will be the software companies that got disrupted by this AI technology. I think there are a lot of software companies you have to be very, very careful of how they're actually going to adapt to this now broad-based availability of AI. In other words, these software companies that used to have a moat potentially just had their moat robbed from them thanks to Bard and ChatGPT and these plugins that for very cheaply, for basically the cost of the server access, which you're spending money on anyway, you could be caught up on AI levels. So not for all purposes, obviously. Like, for example, you know, at HouseHack, for example, we have our Wedge Finder. This is an AI that we trained on top of Google's database, and it's our own personal training. That training's not available on something like a Bard or ChatGPT. But if it were, which I know you could do like a plugin, Zillow, look for Fixer Upper, but that's just any listing that's listed at Fixer. That's different. But if all of a sudden, like, all of our training data were suddenly available on something else, well, then the money we spent on that wouldn't be worth that anymore. Right now, we still think it's an incredible proprietary advantage that we have, specifically because it's trained the way I operate, right? But the long-term argument of this is to say that a lot of companies who spent money developing and training AI potentially have just lost their investment because of the Bards and ChatGPT plugins. And it makes it so much easier for other companies to compete. And that competitiveness is something we're going to have to watch for. So point of this is, I don't know that now that you've got this debt ceiling default drama out of the way, that you're really going to expect to see a sudden drop in markets. Again, you could see a tactical retracement. I believe that is possible. But I don't think you have real catalysts left for negativity. And I know that sounds crazy. Like, what do you mean? Like, there has to be some kind of negativity left. And I'm like, not necessarily. Again, I'm not here to say the market won't go down in the short term, but I think this is a moment where we have to look and go, well, if inflation is gone, the major catalysts of oh my gosh, war, Chinese second wave, commodities, $200 oil barrels, debt ceiling default, all this crap gone. I mean, the next thing people are going to talk about is like, okay, well, you know, maybe they'll hike one more time or they won't cut that soon. So the market doesn't care. Look at how quickly the market reacted, or how much I should say the market reacted to, oh my gosh, maybe we actually are going to have another 25 BP in June. What did the market do? It just kept going up. It doesn't care, which is pretty remarkable. And I think that's because the economy is starting to, or the markets rather, are starting to recognize we might actually avoid a recession here. And the recession, if there ever was one, was probably in 2022. Oopsies. Anyway, those are my thoughts. If you want to see my fundamental analysis on whether it's real estate, your job, income, you want all my perspectives, make sure to join those programs on Building Your Wealth. You're going to get nonstop updates to those programs, especially with the AI course and the productivity course, the entrepreneurship course, or the employee. That's all one, right? Any kind of making more money course. We're constantly going to be adding more lectures to that, mostly because AI is also constantly going to be evolving. So we're very, very excited to share all our insights with you. So stay tuned. Join that before June 1st, which is coming up. So click that link down below to learn more. Thank you so much for watching. And folks, we'll see you in the next one. But this is great news. Thanks. Bye.